What's up, y'all?
You're here.
There you are.
I'm
Paula's
here.
was beginning to sweat.
Oh, really?
Told you Paula he was going to be here. No worries.
Oh, okay. Hey, I have this on my calendar for an hour and a half, but the invite's for 2 hours. Which one's right?
Um, we for an hour and a half, but in case it ran
Oh,
over.
got it.
we-
Okay.
we-
I was more worried about did I prepare enough content?
No. In fact, if it's just so that last 30 minutes, even is just Q&A. So whatever content you have up to an hour, and then however much participation and so forth. So we're
Yeah, sure. Okay.
flexible with that.
Okay. Yeah, no worries. We got time. I'll even do a short review in the beginning of last week so people can remember what we're doing here.
Oh, yay. I need to catch up because we were doing a retreat along with that and all the technology.
Yeah, that was a challenge. It really was a challenge. And that's putting it mildly.
It was an opportunity. We don't call them challenges.
Right on, Mike.
Hey, what's up?
I wanted to call it something else, but Lori wouldn't let me.
Was it what is that a PITA? PITA?
Yeah, that or something. I won't even say it because I think we're recording. So
No, not yet, are we? Sorry.
Oh,
Yeah, it says
great.
we're
Oh, great. Yeah, of course. Now you tell me.
Ah,
Right after I went off color.
no, you were fine. We were talking about animals, I'm pretty sure.
Oh, yeah, that's right. There you go. Good save.
I got you. You're good.
So I made T-shirts for the conference. I know it's a tech conference, but what do you think of this?
I can't say your name, so the way AI. Oh. AI, not me.
AI does not equal me, right? Because I still think there's an instinct part to advising. I don't think AI could do it yet. I think there's an instinct and a human connection. Somebody go, hey, AI doesn't equal me. You don't get me when you can go to Chat GPT.
Exactly.
Very true. Gives us some good speaking points, but it doesn't do it for us yet.
Yeah.
I like it. You're going to have those for giveaways or?
Yeah, I'll have them over at the booth. I've got a booth this year.
Awesome.
Yeah, sweet.
Yeah.
So you bringing some crumble cookies too, or anything like that?
Oh, no. Am I supposed to? Can I even get them there?
Yes. No, I'm kidding. From which it was visual, but no, it had come up on my feed yesterday or whatever. I was like, ooh, crumble cookies, those look good. One of our CDCs usually has one of our MOUT conferences, and oh my gosh, they're just so good. They get me in trouble.
Yeah. Food gets me in trouble. Like,
Myself.
the health insurance company sent us a portion plate, and I tried to use it, and I said, "Well, that's too small. Plate's not big enough."
A suggestion, right?
Yeah. That must be for kids. I tell my family all the time. I say, I didn't get this big looking at food.
It took a little bit more than just the look. Huh?
That's
See,
right.
that's where AI really helps, Mike. AI just looks like it's eating food, and we don't see the benefits of it.
There you go. There you go.
All right, well, it's 11:31. Paula, are you ready? I'm going to hit record.
Okay.
Oh, sorry, record.
Okay, good morning, everyone. Thank you for joining us for Cash Flow Wednesday. Today's presentation is titled The Home Run Financial System. My name is Paula McCain, and I'm one of the senior business advisors here at the North Central Texas Small Business Development Center. And hey, Mike, do you know what today is?
No. What is it?
National Financial Awareness Day.
It's our day.
I
It's
tell
our
you.
day.
I tell you,
Huh.
the SBDC is a leading provider of assistance for small businesses, and we are grant funded. And because of that, we can bring all of our services to you at no cost, just like today's webinar. Again, today's webinar, the Home Run Financial System, is presented by Mike Milan, aka Cashflow Mike. A quick reminder, today's webinar will be recorded and posted on our YouTube channel. We will be interactive today, so if you have a question, just raise your hand, put a question or comment in chat. I'll be monitoring that, so we're good. Just let us know if you have a question. A little bit about Mike. He is a seasoned entrepreneur with over 20 years of diverse professional experience in strategic planning, finance, and sales. He's developed 14 startups into well-established businesses, and that's how he got the name Cashflow Mike. Mike's an Army veteran and has an MBA from Baylor University. Go Bears. He's the author of 2 books focusing on financial statements to find hidden cash in businesses. He created a financial management training program called The Clear Path to Cash, and several different financial software products like Cashflow Tool, Finagraph, Path by Simplex, and The Clear Path to Cash. Welcome, Mike.
Hey, all right. Hey, here we are again. Cash Flow Wednesdays, man. I am so excited about this. I really get amped up for this, especially today, right? Especially today. First of all, I'm with Paula, I'm with Lori. I mean, we've been working together now for a couple of months, and I've really felt like I'm part of the group. So thank you for having me. I feel like we're kin up here. So I really like that. Good. So if you were here last week, we started this whole thing off with the end in mind. If you're going to run a business, you kind of have to ask yourself, what is it that I'm trying to do? Why is it that I want to run this business? What do I want to do when I leave this business? And that's a weird question to ask. Like, what happens at the end, right? So last week was all about starting with the end in mind. Let me get into this week real quick. I think it's PowerPoint. Boom, share. And Paul McCain will stop sharing.
I'm done.
And I don't know which one I'm sharing now. That was weird. How about this?
There you go. That works.
All right, there you go. I had too many of those things up. But today we're talking about the home run financial system. But I want to talk just a little bit about last week before we get into this. Now, last week, again, it was starting with the end in mind. Me personally, when I start a business, I'm thinking, what's my next goal? What's the next thing I want to do? What is it when I'm going to leave this business? In my first business with the hotel staffing company, I felt like it was too hard to scale. I just had to keep opening offices. I had to keep traveling around the country. I'm like, there has to be a better way to scale a company and make it bigger, faster. And what I came up with was software at the time, right? This was 2012. Software was really starting to become part of our lives. And I thought that's where I wanted to be. So my goal when I left the hotel staffing company was to buy into a larger, more scalable company. All right, so that's what it is. So it doesn't always have to be retirement. It could be anything you want to do next. If you're going to put time, blood, sweat, money, your savings, your relationship sometimes into a business, why are you doing that? So what we did last week, and you can go look on the YouTube channel and go back and get the calculation, is we came up with what is that next thing, but put a price tag on it. What is it going to cost me to do whatever it is I want to do next? And once you know that, you can start to backwards plan your business. Remember, business profit, cash, this is not a surprise. You shouldn't be surprised by how much money you made at the end of the month. This is a planned event where we are taking the actions to get a certain result, right? So I used a backwards planning model I call the results-driven planning model, where I took the income statement and flipped it on its head, where instead of starting with sales and subtracting out all the expenses till we got to a profit number, I started with the profit number to determine how much we had to sell in order to be able to generate that much cash for us in a concept I call transferable value, where we take money out of the company and transfer it to who? Us, right? We want to transfer it to us to be able to fund our future. So that's kind of where we were at last week. And near the end, I worked on a little bit of soft skills about what makes a business successful. And we talked about like creating a value proposition. And to me, a value proposition is nothing more than really a mathematical equation, whereas uh, you know, perceived benefit minus perceived cost equals value proposition. So whatever benefit you think you're deriving, is it worth the cost? Right. And sometimes we think it's a bargain and sometimes we think it's a rip off. But in general, we just want things to equal. We want it to feel right. Right. What I'm paying for is what I get. So that's kind of where we ended last week. And we also talked about successful business owners being a chameleon. And what I mean by that is talking to people the way they like to be talked to. We all kind of fall onto this social styles model where I might be a driver, I might be an expressive, an amiable person, or an analytical person. But if I can match that style pretty quickly, I can get along with anybody just by kind of communicating with them the way that they like to be communicated with. That's probably the reason why we have good friends, is that they like to talk to us. That's the human connection part, where you can kind of see on my chest today when I talk about human connections. Yes, there's Chat GPT. Yes, there's lots of AI tools out there. Yes, they can solve a blank page for you. If you don't know where to start, if you don't know how to organize a thought, Chat GPT is one way to be able to get you there. But you have to have instinct. You got to be able to look at things that are outside the computer screen to be able to make decisions about how your business should run. And that's why I say AI doesn't equal me, right? Because I am the instinct that creates and makes decisions in my own business. Use the tools, use the technology, use your gut, right? All those have to kind of work in harmony. So today, we're going to talk and switch gears just a little bit. And if you listen to me already, you can tell I can get a little windy, I can get a little long, I can just go, so I'll probably talk for the next hour and a half. And I don't want to get past you. I don't want to move too fast. I want to go at your speed. So don't be afraid. Raise your hand. Don't be afraid to throw it in the chat. Don't be afraid to just say, hey, Mike. It's a small enough group today. You can just say, hey, Mike. I used to be a state trooper as my first job. I can handle interruptions. I can handle disruptions. Just get my attention, because I don't want to move past something that you think is important. I want to be there for you when you want that answer. So with that in mind, let's talk about this home run financial system. Now you're like, what is this home run financial system all about? If you've ever seen, or if you haven't downloaded it yet, first of all, I want to thank again the SBDC. I did put this in every week, Paula, for you. So I'm re-emphasizing, our relationship and what you're trying to do. Make sure you contact them for all the resources you need to grow. They have a wealth of experience and experts and resources, and they have their finger on the pulse of business up there in North Texas. So contact them. Myself, I think we just talked about 14 companies. Can you believe it? I can believe it. Here was something. I just finished my third book, right? So I've written 2 books. One of them, my first one, was called Don't Be a Dumb Business Owner. Dumb doesn't mean unintelligent. It means I don't understand my business. And it is 8 concepts that maximizes cash in any business. The second one I wrote is the one we're going to kind of go over today. It's called the 7-minute conversation. It's how to analyze any company's financial statements in 7 minutes or less. You can get a free copy right now off my website. Go to cashflowmike.com. Just download the book. It's right there underneath the header video where it says, are you ready to master cash flow? Right underneath that, get your free copy. You can have this and go with it. These are 6 calculations to analyzing any company's set of business financial statements, and we're going to kind of go over that today. The third one I wrote, I don't even have it off the press yet. It's at the press. It's called Don't Tell Me What to Do. And it's about client relationship conversations, how to talk to somebody, find issues, and actually solve issues. And it is part of a series of this. You can see don't be dumb. Well, don't tell me what to do is kind of an extension. This is the math. That's the conversation. Putting those 2 together makes your client relationships a little bit more powerful, a little bit more viable, a little bit more robust. So that's it. So, but here's the thing. My daughter saw that I wrote a third book. She goes, I didn't know you was writing a book. I guess I do these things, and she is an adult, so she didn't see me every day, but I wrote this third book, and it reminded me. She goes, well, what are all the things you've done? And in the book, I kind of put this list, and everything from jumping out of airplanes to falling in love to, being a state trooper, being in the Army, to all this stuff. she reads one of the lines in there. She goes, "You wrote a poem?" Yeah, believe it or not, I even wrote a poem. It got published in the Missouri State Troopers magazines, and then it got picked up by Poetic Voices of America in 1995. So I had a poem written in 1995, and it was about my experience of sitting in a patrol car and what that was like from my side of the windshield, as opposed to the person being pulled over. So it's kind of an interesting thing. I posted it on our podcast called mikeandblaine.com. So if you use Facebook and you want to see the poem, go to Mike and Blaine from Facebook, our page, and I think it's one of the images there in the feed. You'll be able to see that. So that's kind of a funny thing about this. All right. So again, today I'm going to show you not only the calculations, but I'm going to just show you the app. I know that people, I'm going to be training the SBDC advisors how to use this app with you as well. So they'll at least get a taste of what it looks like and what it feels like and how to use it with at least this one calculation today. Over the next 2 weeks, we're going over a lot more math. So if you're interested in having applicable financial management skills, which means things that you can use, not things that are way up in the pie in the sky type of air thing. It's things that you can use, like you and I together at a desk to solve business problems. So that's what we'll be doing. So let's talk about this. Today, I'm going to be teaching you 6 different calculations on the home run financial system. Now, I call it the home run financial system for this point. There's generally a set of financial statements that we all use that are common to most all of us. What are they? Anybody know? Paula, you know one? Yep, good. Profit and loss or income statement. What's another one? Balance sheet.
Balance sheet.
Yep, a third one. Cash flow statement.
Mhm.
Some people will say the bank statement as well. Now, let me tell you a little bit about that, right? So the bank statement's only going to tell you if you had a good or bad day, right? Do I have money or not? That's about all it's good for is do I have money or not? The income statement is going to tell you if you had a good or bad month or quarter or year, and then it starts over, right? Well, how does it get to start over? How is it just that we went from January 31st to February 1st and we're like, we blew it in January. Don't worry about it. We'll get them in February. How do you get to start over? Anybody know? What is the mechanism that gets you to start over?
Fiscal year, maybe?
Okay. What if we start over from January to February or February to March or March to April?
Or your annual year? Sure.
Your ending
Okay.
balance.
Yeah, the profit or loss or whatever is on the ending balance gets moved off of the profit and loss statement. That's what clears it out. We subtract it from profit and loss and we add it to retained earnings on the balance sheet. So that's one of the places that these income statement and balance sheets connect, is that net profit becomes retained earnings or equity, right? It's like putting money back into your own company in the form of profit. So that's one of the things we'll talk about. That's what makes it be able to start over. It gets off of the income statement and then we start over the next month. The balance sheet, though, is the one that most people get confused about. They'll look at it and they'll go, I know that this number is supposed to match that number. The assets is supposed to equal the total of liabilities and equity. It matches, so my bookkeeper's doing a good job. That's about as far as most business owners will go. So like, yep, it matches. So I think we did a good job. We did everything right. What it does, though, is that it never gets to start over, just like the income statement. It will tell you if you have a good or bad business. It is the culmination of every single decision you've ever made in your business. It is the living history of your business in one sheet. And it tells you what you own, what you owe, who owns you, who you owe, all of the things that you've done. If I bought something, if I sold something, all of it is recorded on the balance sheet. So the history of your company is there. And those people that know how to read the balance sheet know a lot more about how their business ticks, right? So we'll spend a little bit of time on the balance sheet today and a little bit more in the next coming weeks. The last one is the one that confuses people the most. And a little bit later, I'll tell you why it confuses people, but it's called the cash flow statement. And the cash flow statement is the tattletale of your business. It tells on you. Anybody that knows how to read a cash flow statement knows where the money came from and what you did with it, right? So today, by the end of today, you will be able to not only do a simple calculation from the income statement and the balance sheet, you'll also be able to read a cash flow statement in 15 seconds or less. Think about that, 15 seconds or less. You go from not knowing what it is to being able to understand it in 15 seconds. So that's my goal for today, is to give you those tools so you can use them and put them to work every day. So let me tell you, before we get to this, let me tell you why I created this. At one point in time, I had a hotel staffing company, 3 bar restaurants, and a property management company all running at the same time, 5 different LLCs, right? And there's a big story, and I think I told it last week about how I got from hotel staffing to restaurant and bar, and it was a cash flow problem, quite simply, meaning that Marriott was paying me in 90 days and I was making payroll every 2 weeks. Well, I took a lot of cash to do it, and I just was running out of cash, right? I was successful. I was making money. I had a lot of business. I was growing. I just couldn't keep up with the growth. So I bought a mismanaged restaurant to bring in cash every day. So at least I wasn't waiting 90 days. I had something coming in every single day. I liked it. So I built a restaurant, and then I bought a building with some apartments and a restaurant in it. And then I bought 9 more buildings. And that's kind of how you end up with that history of companies all working together. And people go, well, how did these things even work together? Because at the end of today, I'm going to talk about sideshow businesses or sideshow ventures that can kill a company. And I'll show you why this one worked together as opposed to why other ones don't work together. So that's kind of a teaser for the end of today, why some things work and why some things don't. But at the time when I created the Home Run Financial System, it was about how do I manage 5 companies at once without going into a deep dive analysis and doing full ratio analysis on every single company. That's where I'm saying I just need the most important numbers, the things that will get me into trouble right up front every single day. So that's what this is. It's 6 calculations that tells you where the hot spots are in your company. So you can spend time in places that matter, and you're not wasting time chasing down some things that are already working pretty well. So that's kind of the goal of it, this Home Run Financial System. Now, some people go, why do you call it the Home Run Financial System? Well, I'm a baseball fan, but because I'm a baseball fan, I like to think that this touches all the bases, right? You know, in a home run, when you hit a home run in baseball, it's first base, second base, third base, and then you go home. Well, first base, second base, and third base for me are the income statement, the balance sheet, and the cash flow statement. So it touches all the bases. So we're hitting a home run when we analyze the company. That's kind of what we're doing here. Most people don't know how to use all 3. You're going to learn today how to use all 3 at once. All right. So before we begin, yeah, you didn't know you just signed up for a math class. Not only did you sign up for a math class, we're going to do math. So I need to get that math muscle working. I need to get it fired up, and because all day long we're going to be going over some different calculations, but let's get some of the basics. Let's agree on some basic things. Why don't you take the next couple of minutes and work through these on your own, and then we'll go over them together. So take a few minutes, work on these on your own, and we'll get back together and check it out. So Paula, Financial Awareness Day. I did not know that, so that's pretty good. I wrote it down, took a note.
There you go.
Need to be exact, or is round or what's it called? Rounding, is that okay? Like, is it, or should we be striving for the exact percentage?
Rounding's good. I think we can round. Let's keep it, or what's that thing? KISS, KISS. What does that mean? You guys
Keep
know
it
what that means?
stupid simple. Yeah.
Oh, you guys are so negative. It's keep it super simple. Yeah. All right. So just rounding's good. Yeah, we'll keep it rounded.
Or like just so I can do it in my head. Otherwise, I would have to write numbers on paper.
Yeah. Hey, so I'm probably the only one that still has one of these on their desk.
Nope.
I have one on my phone.
Yeah. Yeah, Paul's got one too. I don't know. I prefer it. I prefer it to the phone. I can do a little bit more with it.
You can hear a click clack sound.
I like the click click. Yeah, you guys ever seen that show that came out about BlackBerry? It was
Yes.
right, and one of the things they were trying to do was make sure that it had clicks, because the early iPhones didn't have that, and now it does. But yeah, that's interesting.
It's a rewarding sound for some reason.
Yeah, I did something. Yeah, it's instant feedback. All right, let me do this. I'm gonna fill up my coffee cup while you're doing that, and we'll probably be ready by the time I get back. Be right back. Don't want to stop.
On the stop video.
Oh, there it is. I had to find the what you call it.
There you go.
There you go. Got it. Now, if I remember right, last week I said there was a handout to this. Is everybody aware of that? There's a handout that gives you kind of half the notes already. Paul, is that part of the registration that they get that or no?
Defer to Lori. I know I've seen it.
Okay. Let's
Let me
see.
see if I can find it.
Yeah, in case somebody wanted to, because it follows my slide deck, slide by slide, so you can kind of have some of the information already there, and you can kind of just take more additional notes if you wanted. How we doing on time or getting through these? I think there's 1, 2, 3, 4, 5 questions.
On the last one.
Okay. Couple more minutes in. Or a minute. All right. Anybody need more time? Nobody? All right, let's kind of go through them then. All right, so first of all, how would you express 0.234 as a percentage? How do we do that? Anybody? Nobody knows? Just me?
23.4%.
There you go, 23.4. All you're doing is moving the decimal place 2 points, or you can, I think it's multiply it by 100. Right, so I think you multiply it by 100 is how that works, right? So 0.234 times 100 equals 23.4. So multiply by 100. All right, the next one, the hardware store forecasts their sales are going to increase from 250 to 460. How much did it go up? All right, a lot of people get this wrong. Like they think percentages differently. So how much did it go up in percent?
45.65.
Say it again.
45.65.
I've 84%.
84%
More
too.
than double.
All right, so here's how you do these. There's an annotation there. Here's the rule on how to do this. So if I do this, I've got new minus old divided by old. So if it's a positive number, it's a percent increase. If it's a negative number, it's a percent decrease. So the new number is 460 because we went from 250 to 460. So 460 minus 250 divided by 250 should give you the percent increase, and it's 84%. All right. What about the next one? The next one is the difference between markup and margin, right? It's something that they teach in a lot of economics classes, a lot of intro to business classes, but a lot of people get it confused or get it wrong. So what is the gross profit margin of a company that buys a shirt for 26 bucks and then resells it for 40? What is the gross profit margin that they get on that sale?
$35%.
Okay. I want that on the, turn it off.
So we got 35%.
All right. Now, that means how did we get there? How did we get that?
Isn't it the same as the one before?
26 over 40.
26 over 40?
40
Oops.
minus 26, 14. Over
Yeah, so
40.
yeah, so 40 is the sale, and we subtract out what it would cost. And that equals 14, right?
14 over 40.
And 14 divided by 40, the sale equals 35%. Now, what's the next one? That's gross profit, right? That's how much money we'll have left over after every dollar in sales. We'll have 40% of it left. What is the markup on cost? How much did we mark it up? We bought it for 26 and marked it up to 40.
$14.
$14. So 14 is now what? What's the markup percentage?
$14 over 26.
That's right, 14 over 26. So instead of where margin is a percentage of sales, markup is a percentage of cost. So 14 divided by 26. Make sense? This is markup. This is margin. Okay. And the correct answer? Who's got an answer?
It's 54%.
54%. Okay. Now, this next one, believe it or not, as simple as it looks, I have had some of my clients reprice their entire store because they got this question wrong. So, what do you think it is? I bought something for $54. I want to make 25% gross profit. What price should I put on the price tag?
67 and a half.
67 and a half. Anybody got something different? All right. The most common incorrect answer is 67.50. All right. The correct answer is $72. All right. So let's kind of go through that, right? Because this is one of those things you're like, going, man, how did I get there? Because most people, what they'll do is they'll take 54 and they'll either multiply it by 1.25, right? Or they'll take 54 and multiply it by 0.25 and then add it back to 54, right? So one of those two ways will get you 67.50. But that doesn't mean now that 54 isn't going to be 75% of the cost. So that kind of was confusing. So let me kind of explain. Here's the basic rule. I'm going to show you two ways. I'm going to show you the hard way first, and then I'm going to show you the easy way to do it second. All right. So the hard way is first. And we're just going to say that something cost $1, right? Keep the math pretty simple. But this is one way that you can get to the right multiplier. If you're the type of person that wants to have something to multiply by, like what do I multiply it by? This is how you get to that number. Or I also have a gross profit pricing calculator. If you want that, just email me. I'll send it out, right? So where you just put in those two numbers. How much did it cost? How much do I want to make in margin, which is 25%. And I'll show you that calculator here in a second. So right now, an item costs $1, and I want to make 25% gross profit. First of all, how do I know I want to make 25% gross profit? Anybody know? How do I know that? Well, if you don't know where to start, right, there's a couple different things you should do. One is, well, what does everybody else make, right? Because the SBDC has a database of industry averages, and if everybody else is making 25%, well, then I should too. But you got to remember, the industry average is for C players, right? They're average. They're getting a C in business. So we can always do a little bit better, but at least if you don't know where to start there. Otherwise, look at how much you're spending per month, right? And add to it the desired amount of profit that you want to make. That's how much gross profit you need, and determine how much you need to sell in order to cover it, in order to have enough money to pay for your expenses and have enough money to cover your profit. And we can kind of show you that over the next couple of weeks. But in this case, let's just come up with a multiplier, right? What is the multiplier for 25%? So in this case, I'm going to take $1. I bought something for $1. If I want to make 25%, then I know that the cost has to be 75%, right? That means $1 is equal to 75% of whatever I sell it for. The rule in math is this: if I want to know a number that's larger, I divide. If I want to know a number that's smaller, I multiply. So in this case, I'm going to divide. What do I divide? 1 divided by, what would I divide it by? Yep, 0.75, right? So 1 divided by 0.75 equals 1.33. So instead of multiplying $54 by 1.25, we would multiply it by, anybody know? 1.33, right? That's how you could come up with what number you should multiply it by. Because in this case, 33 cents should equal 25% of the sales price. And to figure that out, we go 0.33 divided by 0.25. What's that number? So 0.33 divided by 0.25 equals 132. So some rounding, I must have rounded up to the 0.33. But yeah, that's how that works. Now, here's the math. 133 equals 1 divided by the cost of goods sold. So 1 divided by 0.75. There you go, 133. Let's see how I got that. Okay, that's the hard way. Let me show you the easy way. Is anybody on the call do a Sudoku puzzle? Sudoku? I don't even know how to pronounce it. Well, this is 2 versions of it. I use what I call a mini P&L to solve problems like this. It's something really simple that you can use to answer a lot of different questions. But ignore the right side. Let's just look at the left side. First of all, I've cleared the noise, which means this is just the main parts of an income statement. It's how much sales, cost of goods sold, gross profit, operating expense, and net operating profit. Just the main parts. This makes your business viable or not. Who knows the difference between the expenses that go here in cost of goods sold and the expenses that go here in operating expense? Anybody know the difference? What things do I put in this group of expenses and what things do I put in this group of expenses?
You're not selling and making a profit, or it's things that.
Yeah, real close. All right. So here's the thing. Let me give you some examples and let's see if we can get it. What about in our case where we had the $54 that we bought for the shirt and we want to sell it for $72? Where does the $54 go? In cost of goods sold, right? Because it's an asset, first of all. I mean, it sits on the shelf as an asset until somebody buys it, and then it's an expense because I don't have the asset anymore. So I've got to put that 54 somewhere, and it goes into the cost of goods sold. This is what it cost me to sell that, to get the $72, right? So that's what that is, $72. So, and I'll go back to that in just a second. Now, here's what you have to ask yourself. Would I owe this if I didn't sell anything? Would I owe it if I didn't sell anything? If the answer is yes, it's considered an operating expense. If the answer is no, I owe it only because I sold something, then it's a cost of goods sold. So when you think of things like, oh, I bought that t-shirt, oh, it's only an expense because I sold it. What about a commission on the sale? Where would that go? If my salesman sold it and I paid him a commission, is that a cost of goods sold or is that an operating expense?
Cost of goods sold.
Yeah, right. What about I have warehouse workers and they work for an hourly rate, and sometimes they work 60 hours a week, sometimes they work 20 hours a week.
Operating expense.
Yeah, because I could sell 0 and I still owe them for the hour, right? So that doesn't matter. Now, what about utilities? Think about air conditioning.
Still operating expense.
You notice what I did here? Most business courses will call these fixed and variable expenses, and people get confused on what that is. Your variable expense is things that you only pay because you sold something. Your fixed expenses are down here. That's why when I say, what about a warehouse worker with different things? Just because the amount varies doesn't make it a variable expense. Just because your air conditioning is more in the summer than it is in the winter doesn't make it a variable expense. It's still a fixed expense. You have to think about it that way. Do I still owe this even if I sell 0? One of the things that gets people confused is, what about advertising? What about advertising? Is that fixed or variable expense? Sometimes I do it, sometimes I don't.
Fixed.
See, Laura says variable. It is fixed, right? Because I can advertise. I can go out there and do a $40,000 radio campaign and sell 0. Do I still owe the radio station?
Mm-hmm.
It's a fixed expense, right? So that's where people get off balance. It's not that the amount varies. It's, do I owe it because I sold something? That's what makes a variable expense. Now, one of the ones that people say, well, what about pay-per-click advertising? Is that a fixed or variable expense?
Still advertising.
Yeah. Have you ever left the shopping cart? Like, I clicked on an ad, it went to the shopping cart, and I go, I don't want it. And I just leave it. Yeah. So you can actually, does that person still owe for the click? Yeah, they still owe, right? You didn't buy anything, but they still owe for the click. That makes it a fixed expense. So that's one of the things I try to clear up with people, because when you want to compare yourself to the industry average, you should know that most people are considering what goes in here and what goes in here. And the question you ask is, did I owe this if I didn't sell anything? People's wages, advertising, office supplies, those type of things. All right, back to the original question. I bought something for $54. I want to make 25%. Now, I call it a Sudoku puzzle because I make 2 columns instead of 3 columns with 9 things. It's 2 columns with 10, I guess. On the left side, I put the amount in dollars. On the right side, I put the amount in percentage. Everything is a percentage of sales. So I put 100% there. Now, if you know what Sudoku is and what the object is, it's only one number fits in every box, right? Only one number will fit. That's the concept I want you to wrap your mind around. So if I do a word problem and say, well, I bought something for $54 and I want to make 25%, what else is true? Now, I threw $15 in here just to show you an example of how it pays for your operating expenses and how much is left over. But if I want to make 25%, then I know 100 minus a number equals 25, and that's 75. Pretty easy, right? Now, because I just filled that in, I know that 54 is 75% of sales. So if I want to know a number that's larger, I divide. 54 divided by 0.75 equals, anybody? 54 divided by 0.75. Good, 72. 72, right? Now we can go kind of follow this down. 72 minus 54 equals 18. If we did it right, I said only one number fits in here. So 18 only works if 18 is 25% of 72. Can somebody do that? 18 divided by 0.25. 18 divided by 0.25.
72.
Yeah, 72, right? So 18 minus 15, if this is the way we were planning, hey, I should make money, right? That's basically what this says. That's what happens in your Excel spreadsheet. You're like, oh, we're golden, we're good. Then I hand the pricing gun to somebody in my office, or I do it myself, and I come up with the wrong thing. And I come up with 67.50 because I did the math wrong when I went to put the price on the goods. And I went click, 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 67.50 on everything. If I did it right, I should make money, right? Based on my plan. But here's what happens. They don't see it until after all the sales happen. You're like, why didn't I make money? Well, 67.50, the price of what you bought the t-shirt didn't change. So 67.50 minus 54 equals. Anybody? 67.50 minus 54. How much did we make? 13.50. Now, what I said is, if we did it right, only one number will fit. Is 13.50 25% of 67.50? So take 13.50 and divide it by 67.50. How much is it? Yeah, it's 20%. 13.50 divided by 67.50 is 20%, which means we left 5% in the pricing gun. Just by doing that quick calculation, we left money on the table. And because we left money on the table, 13.50 doesn't cover our expenses now. And we go from making money to losing money when our plan was one thing and our execution was another. All right. So that's one of the reasons why I do that, is just get our brain working. Just, make sure that we know that only one number can fit into all these boxes, and it has to tell a story. So questions on that, comments? This mini P&L, I use it to find break even. I use it to determine if I want to add expenses, how much do I have to sell? I can use it to answer about any question that somebody has about what we should move or change in a business, and make it simple enough for you to take action. All right. So let's go back to the common financial statements. Remember what they were: cash flow statement, balance sheet, income statement. And I said the cash flow statement was the one that confused everybody. Well, here's why it confuses people. The income statement will start off with sales, right? And we'll start subtracting things out until we get to net profit. Make sense? We just got sales, cost of goods sold equals gross profit minus that. It's minus, minus, minus. We start with one high number and then subtract things out to get to the end, the result. Vertical. On the balance sheet, the numbers can go up or down, which means if we have cash in the bank, the number could go up, right? Cash can go up. I put money into the bank. If I write a check, the number goes down, right? My number in my bank account goes down. I can see it moving. Cash in, the number goes up. Cash out, money number goes down. So it's still vertical math. The reason why people get confused on the cash flow statement is they're like going, I don't know how they got to this number, because we're so used to doing vertical math, starting with a number and subtracting or adding to get to it. And I can see all the transactions that equal this. Well, the cash flow statement is what we call horizontal math. That's why it's so confusing, because we're used to looking at numbers like this. But this would be like period 1, we'll say January 2023 to period 2, January 2024. Whatever it was here to whatever it was here. The number you see is the change. So if it was 500 here, and it was 200 there, what number would you see? 500 in period 1, and then you see 200 in period 2. There, Brett got it. It's negative 300. The thing is, you couldn't go and look in the transactions and try to come up with negative 300. You're just not going to see it that way, because it's the change in the balances over time. It's the difference between vertical math and horizontal math. That's where people get confused, right? And I get it. It's hard because people try to add this stuff up, and it's not going to add up because it's just a change in two results. All right. Make sense? Cool. on the ink and off. So let's talk about how these connect, right? And why they work together. Usually we start off with the income statement. We got revenues, we subtract out our expenses, and it comes up with some type of net profit. Now, the one we didn't talk about, the one that we don't normally see because the accountant kind of does it in the background, is this thing called a statement of retained earnings, which is how much did I put into the company in net profit and how much did I take out? Did I give myself a little distribution, a little dividend, a little bonus? If I did that, then the ending retained earnings is what we'll see. So the $1,000 goes into the statement of retained earnings. If I took any money out, it will be listed here. So 4,000 plus 1,000 minus 2 equals 3,000. That's the number retained earnings that gets put on your balance sheet in the form of retained earnings. So whatever that number is, 3,000 is going to get added to it. Or if you have negative retained earnings, it'll get subtracted from it. So that's kind of where that is. That's your equity. This is the number that bankers use to determine how much you can afford to pay for debt. You know, those type of things. I mean, how much money do you actually get, you know, at the end of the day? So this is the number that they use to determine how much you're going to afford. And later on in this Cash Flow Wednesdays, I'll talk about how to calculate that up. Today, we're going to tell you a way to calculate up how much long-term debt you can afford. Later on, I'm going to talk about short-term debt. All right. Now, the cash flow statement's on the other side, right? Everything kind of flows into the balance sheet. That's why it's the history. It's where everything lands. So in this, we got operating, investing, and financing activities. If you don't know what those are, this is operating is just your core business. Does your business make money? Can it support itself? Investing activities is when you go buy stuff. You buy a truck, you buy a building or whatever. That's I've invested in the growth of my company. I'm trying to grow it, and to grow it, I have to buy stuff that we call assets. The only reason to buy an asset is to generate revenue or profit. Don't be like my uncle to do it not to pay taxes. I mean, he and I argued about this at Thanksgiving last year about he wanted to get a new tractor because his accountant said he would save $25,000 in taxes if he bought a new tractor. I said, how much the tractor cost? He said, $210,000. I said, so you spent $210,000 to save 25. I said, did you get more land? What was it about this tractor that you're not going to generate more revenue? You're just paying more money. You paid more money by getting this new tractor. Okay, then you wanted a tractor. You didn't buy it for the business. You didn't buy it to save taxes or to save money because you would have actually had $200,000 more money. You did it to save on taxes. Don't do that. Anyway, financing activities is where did the money come from to actually get this business going? Who owns this thing? It's you. If you took a loan from the bank, it's you and the bank. So that's where this money comes from. So those are the three. And when you add those together, it comes up with a change in cash. And then you add in the beginning balance. How much did you already had to begin with? Well, our ending cash balance at the end of this statement is $1,650. And that should match the balance that's on the balance sheet, right? So the cash flow statement ending cash will match what the balance sheet's cash balance will say, right? And we'll go over an exercise today about how that actually works in real life. All right. That makes sense how everything is flowing into the balance sheet. That's basically what I'm trying to say here. Those are the three things that flow into the balance sheet. All right. So for the next 3 weeks, we are going to talk about Sammy. All right. And the reason why I bring a character into this is a real life consulting client of mine. He didn't look like that. I just thought it was a funny picture. But Sammy owned a paint manufacturing company. His dad started it in Wentzville, Missouri. And it's a person I worked with about 2016, 2015, 16, somewhere in there. And Sammy was trying to get a line of credit for a contract that he was trying to get with True Value. Right now, the reason why I use the story is that makes the numbers come to life. If we're just doing math, it doesn't make a lot of sense, right? We're just doing math. But if I tell you why things happen and what was going on in the business, you can now take the lesson and apply it to your own life, right? Because you know the story of your own business. So Sammy then, his dad started it. He's run it. He took it over from his dad about 30 years ago. He's been doing the same job now for 30 years straight. His wife works there. His son works there. And they kind of all run this together. So they're on the verge of getting a contract with True Value to take their paint and put a True Value label on it and sell it back to True Value so they can put it on the shelf. That's kind of the situation. Now, what they were asking me to do is help them get set up to be able to get this financing. So that's the scenario. Does that make sense? All right. So I think in your handout, I've given you these financial statements so you can kind of follow along. But what he gave me was just 5 years of income statement, 5 years of balance sheet, and cash flow statement. So what you're seeing here is the income statement and the balance sheet. Later on, I'll introduce the cash flow statement. But this is year 1, year 5. If it helps you, I think at the time it was 2011 to 2015. I don't care if you think about it, 2021 to 2025. So whatever makes you think that year 1 is the oldest year and year 5 is the most current year, that's what we're working on, 1 to 5. So, and this is just how it laid out. Now, if we were in an in-person seminar, I mean, I think like Paul has been to, I'd say, hey, take a look at this and tell me what you see, right? Because what I've noticed in my in-person seminars is that every single person kind of attacks or analyzes the financial statements differently. There's no real methodology. One thing's important to one person, and another thing's important to another. And I think during the in-person, Paula, I become Sammy. I actually role play that I'm Sammy and have you ask me questions. So we don't have the same time frame to do it here, but this is kind of what this wraps into. But is there anything that stands out? Is there anything that you'd want to ask a question about before we begin? Anything you're looking at, so that looks weird, that looks odd. Anything? Anybody?
It looks like sales are going down.
Yeah, it looks like sales. It looks like me, so that's doesn't look too good right off the bat.
But costs are also going down a little bit, maybe.
Yeah, so which cost?
The cost of goods.
Variable or fixed, okay? So cost of goods sold, and it should, right? Because if we're managing the gross profit, our pricing doesn't change. So yeah, cost should go down if sales go down, okay? What about expenses? What are they doing?
They're going down.
Okay, so he's cutting expenses. At least he sees it and he's trying to do something. Anything over here on the balance sheet you see? What happened to like net fixed assets?
It went up quite a bit.
Yeah, he's buying
Purchased a
stuff.
lot of it.
Yeah, he's buying stuff, right? He's buying things. I mean, even his inventory went up a little bit, right? So he's trying to gear up for this new big contract is basically what's happening. All right, what about debt? Look at here, long-term debt. Owed about $1 million, now he owes 700,000.
Sold something.
He's just paying down debt, right? That's
Yeah.
all this means. I'm paying down debt. And his thing was, hey, listen, I don't want to give my son a bunch of long-term debt, so I'm trying to pay it down before I turn the company over to him. So, do you guys ever have that? Anybody got people like they want to pass things down to their children, a business or whatever? You guys heard that? The old joke is, the first one builds it, the second one grows it, the third one destroys it. You guys ever heard that? But really what I think the best advice I ever heard about working with children is before you turn your company over to them, go make them work somewhere for about 3 or 4, maybe 5 years. All right, go make them work somewhere else. First of all, if they're young and they have a maturity problem, they'll work it out with somebody else instead of in front of the people that they might have to lead later, right? Secondly, they're going to see other ways that people do things and come back to run your company with a little bit more experience and some new ideas, something fresh, right? They don't get just wrapped up into what's happening for the last 30 years. They get something a little bit different. So they probably won't like it. They're not going to be shipped off to somewhere else for 3 or 4 or 5 years, but it will be better for the company in the long run if they do. All right. So let's think about it. Here we're getting into all the calculations now. This is the first calculation. And it's just trends, right? We all kind of start there. Matter of fact, that's all we did just now was look at trends. Well, I look at 4 trends specifically, right? Just 4 of them. And I asked 2 questions on each one of them, right? And I'll walk you through it. The first thing I look at is sales. Now, I don't do big math on this because, again, this is supposed to be a quick 7 minutes or less type of thing to do all 6 of these calculations. So I don't do a lot of math. I just use the KISS method, keep it super simple. I first say, is this up or down? It's down, right? Down. And it's down about $1 million, right? So that's all I do. I just keep it rounded up. It's down about $1 million. There it is. Now, the 2 questions I ask are this. Is this good or bad? What do you guys think? Good or bad? Doesn't look right, right? You're like, oh, nobody wants to know that their sales are down $1 million. The second question is more important than the first one. It's about the relationship. Too many people look at these things in silos when they really work together in a concert, like a symphony. So, did I expect it is the second question. So, sales are down, but did I expect it? In 2021, when I looked at 2020 sales, I probably expected it, right? Because of COVID. So sometimes you can explain it away like, yeah, well, everybody had that. It was just a bad year. So we can kind of exclude it because it's abnormal, right? So yes, we'll just say it's no, it's bad, and no, I didn't expect that to happen. So the next thing I look at is gross profit. Now, let me tell you something about gross profit. Gross profit is the most important number in the income statement. You're going, what? It should be sales. I know if I'm growing by sales. No, sales is only a measurement of how much work you did. Gross profit is how much money you had. This is the only place you can get cash to spend on your expenses or put in your pocket. Sales is only a measurement of how much work you did, right? Gross profit is where you get cash from. So if you're going to be focused on cash, you have to focus on gross profit. So is this up or down? It's down, right? Going down. If we did the math real quick, we know it was going down about 450,000. Is this good or bad? Let's yell it out.
It's
bad. To me, I'm like going, I just told you, you have $450,000 less to spend.
Mhm.
Right. Now, the second thing is, did I expect it? All right. So if you see sales are down and you're doing things right, your pricing strategy, you know that successful business owners manage to gross profit because that's the only place they can get cash. If sales are down, yes, I expect gross profit to be down. If I sold less, I should have less to spend. Here's the thing. Sometimes these work in opposite ways. That's why I'm saying you can't look at them in silos. You have to look at them together. What happens if this number was up? If that arrow was up, sales were down, but gross profit was up. What does that mean?
He was cutting something somewhere.
Yeah, we don't know what it is
Prices.
just yet. Say it again.
Or you raised prices.
Yeah, just looking at the numbers, I don't know what he did. He did something right because we're doing less work and making more money. Like, I don't know what that is, but let's figure it out because we want to do more of that. Measurement of work, how much money did you have, right, to spend and keep? The next one is how did we spend it? Operating expenses, how you spend the money. This is how much money you have to spend. This is how you spent it. So this is down. If we did the math, it'd be about 350,000. So is this good or bad?
Good.
Yeah, hey, he saw a problem. He saw sales are down, gross profit's down, so I cut expenses. Now, did we expect it? Do you expect when sales are down, operating expense to be down?
No.
Not necessarily, right? Because it takes a management decision to decrease or increase operating expenses. It does not move with sales. Gross profit moves with sales. Variable expenses go into here, fixed expenses go into there. Now, here's the thing. When we should expect it, it's called hope. We hope that he did it, right? We don't expect it because somebody's got to make a decision. But some people go, well, I hope he cuts expenses because he had less to spend and he sold less. And what I tell people that says they hope something happened is I said, let's not start smoking hopium up in here. let's actually deal with reality. We're not going to be smoking hopium. So anyway, all right. So the end is a result. Net profit, I'll look at it, but I can't do anything to this. I can change how much I sell. I can change how much I'm making gross profit. I can change how much in operating expense. I can't do anything to this. It's just a result. And it's down. And it's down about $100,000. So is that good or bad? Well, nobody wants to make $100,000 less than they used to. Did I expect it? Well, yeah, look at the relationship. Just using the KISS method. Do you see a relationship?
$100,000 different.
$100,000 different, right?
Mhm.
Because I had 450,000 less to spend, but I only cut expenses by 350,000. The difference is $100,000. Who paid that? The owner paid that. He used to have that much when he made $450,000 more. He used to have that in his pocket. Now he doesn't. So that leads me to number 2. So this is the first calculation, just trends. And I look at these 4 things: down, 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 down. Now, because I've got 4 things here, I built a cheat sheet, right? And the cheat sheet is, I just look at it. Oh, I got down, 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 down. Things aren't looking good here, but this company may have cut enough expenses to be able to maintain or increase profit. This company needs top line attention. So I'm telling you that when you do these 4 things, now it tells this story. All of them together, this is what it means. I just look at it. What is sales? Well, sales was down, gross profit, or sales were up, gross profit was down, operating expenses up, but I made less money. Watch out. This could be leading to another situation. So I'm telling you what's happening by looking at all these 4 together. Make sense? And you can download that. And I think on in my website, if you lose this, under the blog section, there's a section called book images. And this is in my book, The 7-Minute Conversation. So you can take it out of the book, the PDF, or you can go to the website and grab it, in case you lose it. All right.
I have a question.
Sure.
Why are these your 4 thingies, and why are you not looking at like variable expenses or anything else?
Can you say that differently?
I guess my main question is why are variable expenses not on here as one of your things?
Because they're captured in gross profit.
Because they're captured in gross profit.
Yeah. So the difference between the two, right? So meaning that, first of all, I'm looking at what's the trend of cash, but the difference between the two would be the change in cost of goods sold, right? Which would be the variable expense. I'm down $1 million here. I'm down 450 there. Chances are I'm down 6 or 550 here, right?
Okay.
Does that make sense? It's an implied because the way I maneuver cost of goods sold by changing my prices or buying things better. Now, were you on last week's?
No.
All right. So last week I said there's only 4 ways to make more money in a company, right? In the operation. It was increasing sales. It was cutting cost of goods sold or buying your goods better.
Mm-hmm.
It was cutting your operating expense, right? Maybe less rent, labor, whatever it is that you're doing. And the last one was increasing price, right? Because I can increase price and not increase sales. I could just sell less, but make more money.
Right.
So it's covered in here, and I think it will make a little bit more sense, but where will it make more sense? Yeah, I think it will make more sense when I show you the graph and the chart and we go over the next one. The next one's about expense control. And it's not cost of goods sold, but it's the connection between these two, gross profit and operating expense. But let me go back to the pricing strategy is the first part, right? Because if I'm trying to get 25% and I do this calculation, I think this is like 32%. If I do that calculation, it's like 32%, but I'd be over my 25% goal. But
I have another question. Does this apply to all kinds of businesses, or is there
yeah,
are there
this
different considerations for different types of businesses?
this 6 calculations work for all businesses.
Mhm.
There will be points in time, especially in the next 2 weeks, where I show you the difference. If it's a service-based company without inventory, you do this. Otherwise, use the other. So the main two big differences is, do I hold inventory or am I a service-based company?
Right.
There's only 5 different types of companies. If you didn't know, one is retail, then you got manufacturing, wholesale, contracting, and services, right?
Yeah,
And
I'm on the services, so
yeah, so
I'm familiar with services business.
okay, so there'll be when we get to the fast money formula and when we get to mining your business for hidden cash, there's a few differences that I'll point out.
Okay.
But in this one, it works for all of them.
So whether it's a service business or you have a product, this will still work.
Yeah, because you're comparing you to you,
Yeah.
right? So that's what we're doing. Is it was what your sales were to what your sales are, what your gross profit was to what they are, right?
Okay.
So because it's only comparing you to you. Now, in other places, it's comparing to industry average or anything like that. But this is your performance compared to your performance. That's why it works.
Okay.
All right. All right. So the next one is expense control, right? There is a hard and fast rule in expense control that if you violate it, you will kill your company. Point blank. I mean, this is one of the things that kills the company more often than not. It's violating this rule. So the rule is this: when gross profit is decreasing, meaning money's coming down, you should cut your operating expense by the same amount. Let me say it more simply. Gross profit is the amount of money you have to spend. Operating expenses is how you spend it. If I have less money to spend, I should spend less money, right? If you took a $2,000 a month pay cut at home, would anything change? Right? And most people, they would. Maybe you can still pay your bills, but you're not going out to eat as much. You're not saving as much, investing as much. You're not going to Taylor Swift concerts anymore. There's something that's going to change, right? That's the same thing in your business. When you have less money to spend, gross profit, you have to spend less money. Now, what most people don't do is they'll graph some things out. And when you look at sales, there's just times that it ebbs and flows. This is showing that sales are going up, then it kind of peaks out and it comes down. This could be seasonality. This could be the life cycle of the company. But in any case, there's times when you're growing, there's times when you're contracting. And because of that, if we're doing it right, gross profit should track right alongside with it, right? Because our pricing is to get a certain gross profit percentage. That's how you price. But operating expense doesn't move like that. If we were to go graph operating expense out, it tends to move like a stair step. As we're growing, we tend to add expenses. You're like, oh, well, why is that? Well, because generally we start to hit the wall. We start to hit capacity. Oh, I need more people. Oh, I need another location. Oh, I need another truck. I need this. We start to add expense because we want to continue to grow, right? And then if we get to a point where we're comfortable, we hold expenses flat. This is kind of a natural thing that happens because the longer I can hold expenses flat, especially when it's growing, right? It's growing like this. The longer I can hold it flat, the more money I make, right? I'll make more money here than there. See that? Gross profit is increasing. The longer I can keep expenses flat, the more money I can make. So that's what we're trying to do all the time. But then all of a sudden, I hit this place where I have to increase expense because my employees go, if you don't get me some help, I'm going to quit. And then you hire another person, right? And then you need it to open another office or whatever you're trying to do. Well, what's interesting is, I want to get the eraser on that. What's interesting is that you hit this point, and I'm going to go back just one. You hit this point. And that point is where gross profit's starting to come down, but I kept increasing my expenses. Do you think I make more money here or here? What do you think? This is number one. This is number two. All right. So anywhere that the gross profit line is above the operating expense line, we make money, right? This is us making money. But you see how this gets shorter? the distance between gross profit and operating expense gets smaller, we make less money here, even though I'm selling more than when I did here. That distance between the two is greater. So this is where you're spending more of the money that's coming in. Now, so the ink on the slide. Does anybody know what that point is called right there? Where operating expense is equal to gross profit.
Break even?
That is break even, right? That means I like to call it practice and working, right? Because we're not doing it for money. We just kind of go in and do it for no reason. We're just going, we're practicing doing our job. But this is generally when this starts to happen, when that number gets smaller and smaller and smaller, this is where you'll see companies in the headlines. Like, what's the last company you seen do layoffs? Anybody seen that headline that says they laid off some people? Who was it?
Dell,
Yeah, Dell. How did they say the number of jobs?
like 12,000.
How did they come up with 12,000 and not 50,000 and not 10,000 or not 4,000? I'll tell you how. Because they're trying to get the role. If you remember this from school, the role of the manager in the firm is to maximize shareholder value. And what that means is make profit, right? And they're okay with making the same or a little bit more, but they're not okay with making less. Shareholders, people that invest in the company. So this is where you see companies, when they start to make less money, like right here, I'm making less than I did back here, they will make the decision to lay people off in this case. And when they lay people off, it reduces expense. Like this. I just laid off 12,000 people because 12,000 people is almost the exact same amount of gross profit that I lost. Right? So gross profit is the amount of money I had to spend. Operating expense is how I spend it. So operating expense has people's salaries in it. When I reduce 7 or 12,000 people, I'm reducing it to about the same amount of gross profit that I had to spend. Let's just say on the 12,000, what's 12,000 times? We'll just say everybody made 100,000. What is that? 1.2 million? Or is it higher than that? Would that equal 12,000 people at 100,000? Let's see, 12,000 times 100,000. That's way too much. Is it 1.2 million? Well, in any case, what they've done is they've added up the amount of salaries and multiply it by the amount of people. And that will also about equal the amount of gross profit that they've lost in the same time period. Now, let me show you in math, because I'm just trying to explain how we get to that number. Why 12,000 and not 4,000 and not 10,000? All right. So in this case, sometimes people don't make this cut. They'll actually let it ride. They'll say, hey, I'm just going to ride out this seasonality. It's just for the summer. It'll come back. It happens every year, and they have enough money in cash reserves. How much money, if you don't know the exact number, how much money should you have in cash at any given time? Anybody know? Got a rule of thumb? Kind of a, rule of thumb, I guess, what it's called.
6 months.
Yeah, 3 to 6 months cash. Yeah, sure. Got it. So 3 to 6 months of cash, that means operating expense. So if I'm spending $10,000 a month just to keep my business going, then I need to have $30,000 to $60,000. Generally, I have more money before I go into the low season, right? Because I'm going to burn cash because I know I'm going to lose money during the slow season. And I can have less money during the high seasons, right? Because I'm generating cash, I'm bringing it in. So 3 to 6 months is how it goes in. Now, it's 3 to 6 months because generally that gives you enough time to work out of a problem. Maybe you had a flood from a hurricane in Houston. maybe COVID, maybe a death in the family, maybe construction on your street. Generally, 3 to 6 months is enough time to work out some problems. That's why we want that. So here it is. Some cases, people will actually not reduce their operating expense. They'll just keep it going. And when I was a state trooper, I used to go to networking events and people say, hey, you know, what's your name? I'm Mike. You know, what do you do, Mike? Well, I'm a state trooper. Well, what do you think is the next question they ask after they learned I was a state trooper? Anybody? What do you think they ask a state trooper at a party? They go, all right, Mike, come on, tell me, how fast can I drive? Everyone wants to know how fast they can drive, right? So, and my answer was always the same, no matter who asked the question, no matter what it was. And it wasn't boring like, oh, you should drive the speed limit, sir. It was always something like, you can drive as fast as you can afford, right? If you can afford a $50 ticket, then drive that fast. If you can afford a night in jail, then drive that fast. And in Missouri, that was over 25 mile an hour over the speed limit. So if it was 75 and you were doing over 100, you went to jail. All right, that's just kind of the way it was. So, but the reason I'm telling you that is that this is what I'm going to tell you about operating at a loss. This is when you lose money. If you make money on this side, when the operating expense is higher than gross profit, this is all the money you're losing. How long can you do that? As long as you can afford it, right? And I had a friend that developed some land. He started developing land. His dad gave it to him in 2005. In 2005, he had 5 houses going up on this plot of land. By 2007, he had 35 houses on this plot of land, right? He was making money. He even built his own house out there. And you know what happened in 2007, 2008, you know, kind of the housing market fell apart. So he's talking to me about, you know, hey, what are you going to do? Right. Remember, I had staffing company, I had restaurants, and the only thing I could do is cut labor. Right. That's all I can do is cut labor to be able to make that. He says, we're going to hold labor steady. I'm going to hold my crews in place. And we're sitting on cash now from developing these houses that as the bottom comes out, as everybody else's houses start to devalue, we're going to buy up a bunch of property for cheap and then have these crews go in and finish projects or whatever they're going to do to repair them, replace them, flip them, and put them back on the market and make money when it comes back. That's a strategy that a lot of people used and made a lot of money through 2008, right? They just bought up undervalued properties and sold them when the market came back. That works as long as you're not burning up all your cash waiting for it to come back, because nobody knew when it came back. It took years to come back. So by 2009, he started losing houses. By 2011, he lost his own house. By 2012, he was selling mortgages in a strip mall, not a developer anymore. So the cautionary tale to me is what he should have done was cut employees to the point where the money that was coming in was enough to cover what was going out. He wasn't doing that. He just kept his crews in place and tried to keep them working because he didn't want to start over. That's the hard part. All right, so let's look at it from a mathematical standpoint, right? You got gross profit minus operating expenses equals net profit. In Sammy's company, he had $450,000 less gross profit, right? $450 less to spend. According to the rule, when gross profit comes down, you need to cut it by the same amount. So he needs to cut $450,000, but he didn't. He only cut $350,000. So that left a deficit of $100,000. I had $450 less to spend. I only cut my expenses by $350. That means out of pocket, out of his profit, he paid $100,000 to run that business. That's what that means. What if he would have cut $450,000? I had $450 less to spend. So 400 minus 300 equals 100. 400 minus 400 equals 0. He would have made the exact same amount of money that he did at 9 million. He would have made the same amount of money at 8 million if he would have just cut $100,000 more. So you can make the same money no matter your sales. That's what I'm saying. Sales is only a measurement of work. You want to manage to gross profit. This is the number. How much money do I have to spend, either more or less, and I need to cut my expenses by the same amount. And I can make the same amount of money no matter what, how much I sell. Selling more doesn't make you more money. I mean, it will, but there's other ways to do it, even when you're selling less. Questions, comments? That's number 2. All right. Number 2 is the expense control. Expense control. First one was trends. He's got bad trends. The second one is expense control. And this is telling me that the advice I would give him is you need to cut $100,000 more in operating expense. So now I know he's got bad trends, and I gave him advice, cut $100,000. All right, the next one. Number 3 is debt to equity ratio. Now, I'm sure none of you are like going, oh, I look at that all the time. No, we don't. We don't look at debt to equity ratio. It's one of those things, though, that I bring up because I was confused when I would get advice from the banker and then I would get advice from the accountant, and it would be opposite advice. One would tell me to do one thing, the other one would tell me to do exactly the opposite. I'm like going, that didn't even make sense, because it used to be you couldn't start a business unless you had 3 people on the team. You needed a banker, an accountant, and a lawyer to kind of help give you advice to get this thing going, get it going, But why would 2 of the people that I trust, well, why would they give me opposite advice? And who's right? And who do I listen to? So I'm like going, how do I make sure that I don't do the wrong thing by listening to one of these 2 guys? Oh, by the way, I've been doing surveys about who do you go to for advice. Do you know where bankers now are? They're not in the top 3 anymore. They rank 7th in my little informal poll. They rank 7th. Behind number 6 is other. I mean, people would rather go to anybody else in the world than the banker to talk to them. They'll go to the bar and go, hey, Joe, let me tell you about the business. See if you can help me. So anyway, the debt to equity ratio is where I figured this out. It's like going, oh, they're arguing about this one ratio, right? It's the big fight. And you can remember debt to equity ratio is total liabilities divided by total equity. So it's D, debt, divided by E, equity. All right. Now, when you look at that, you're like, okay, what does that even mean? Here's where I figured out that they were telling me the opposite thing. What is the motivation for an accountant? What are they really trying to do for you? What's their primary thing that they try to do? Anybody?
Save on taxes.
Pay less tax. What do you pay tax on?
Profit.
Net profit. And earlier we just talked about, where does profit go at the end of the month?
Retained earnings.
Into retained earnings, which is equity. So if I have negative profit or losses, or I have low profit because I'm doing everything I can to pay less tax, I'm also putting low equity into my company, right? That's the E portion, the equity portion. If they lower the income, they also lower your equity in the company. What's the banker trying to do? They're trying to give you a loan. That's the debt part, right? So that's when I go, oh, you guys do that because if the banker wants to give me debt, I have to have equity. The equity is known as my skin in the game, right? My skin is how much do I believe in this company? I believe in it so much that I'm willing to put my own money into it. I'm willing to make money in this company, and I'm willing to pay taxes on it, right? That's what that means. I'm willing to increase the equity in my company so I can take out more debt if I have to. So you're like going, and the banker's going to say, well, if you're not putting in any equity, why should we? Why should we give you a loan? You don't even put your own money in there. So if you won't put money in your company that you work in every day, why should I as the banker do it? That's basically what they're saying. So let's think about it differently real quick. When you go, this is why I'm going to show you, it's about how much you believe in the company. When you go to buy a house, typically, I know you can do all kinds of different, crazy things to buy a house, but typically what's how much do they want you to put in of the purchase price? You guys remember?
Well, it used to be.
Yeah, it's about 20%, right? It used to be that. But that's still kind of their goal. They want you to put in 20%. They'll make you pay PMI until you hit 20% equity, or the mortgage insurance. So if they're wanting your equity in the house to be 20%, how much are they willing to put in?
80.
80%, right? So 80 divided by 20, that's debt that's equity. 80 divided by 20 equals 4, right? 8 divided by 2, it's 4. Yeah, I got a 4. What does that even mean? Well, here's the way you read ratios. The bottom number always becomes a 1. So I have 1 in equity, right? So that's my equity. So if I have a 1 in equity, that's the D part. The top number always becomes the result right here. So that's the top number equals the debt part. Top number is always the result. Bottom number is always number 1. So for every $1 I have in equity, the bank put in $4 in debt. Every ratio is read the same way. The bottom number is always the 1, whatever it is. In this case, it's equity. And the top number is always the result, the debt. So if they let you put in less money as a down payment, say you only put in 10%, that means they put in 90%. What's your debt to equity ratio? 9 divided by 1.
9.
9. The higher the number, the more risk to the bank, right? That's why they want you to be at 4 without insurance on your house. The higher the number, the more risk to the bank. On a business, they won't give you 4. They'll only give you $2.50. So if I read this to you differently, for every dollar you put into the house, the bank put in $4. But on a business, they won't give you that much. They will only give you $2.50. Now, why would they give you less on a business? The business generates money. House just sits there. Why would they give you less money on the business?
Greater risk of return of payback. I mean,
Yeah.
hopefully the mortgage industry, you're always having some kind of equity growth year over year, but not so much with a business risk.
Yeah. So with first of all, I mean, the house, there's a more active market. They can just take it, if you default on a loan, they can take the house, put it on the MLS, and somebody will buy it. Right. Not true with the business. Sometimes they have to break it down for parts. They have to sell. They don't want to be in the business of running your business. So they'll take less risk on your business, right? And it's 2.5. But by you knowing this, that they're looking for 2.5 or less, you can now make the decision on who to trust. Do I trust the banker or do I trust the accountant? Here's how you know who to trust at what point in time. You ask yourself the question, next year, in my plan, do I think I need a loan? Do I need a loan for a truck? Do I need a loan for a building? Do I need a loan? If I need a loan next year, not tomorrow, next year, because they're going to look at the trend of how you run your business, and they're going to look at this number specifically, and they're going to look at it for about 12 months because they don't want somebody just to dump a bunch of money in, make an application, and take a bunch of money out after they get the loan. They want to see that you keep money in the company, right? It's called a trend of a debt to equity ratio. But if I need a loan next year, then I need to get my debt to equity ratio down to 2.5 or less, right? That's kind of an answer to the banking test, 2.5 or less, because they'll lend you back up to that 2.5. Now, every bank does it differently. It could be 3, it could be 4, but 2.5 is the really conservative. That's going to get me in the ballpark, look pretty good. If I don't need a loan, if I ask myself the question, do I need a loan next year to grow? And you go, no, I'm not getting a loan. I'm good. I can grow with what I've got. If you answer it that you don't need a loan, then who cares what the banker says? Pay attention to the accountant and pay less tax. So it's that one question that will help you determine who's right. If I need a loan, listen to the banker. If I don't need a loan, listen to the accountant, right? Okay, in Sammy's company, it's total liabilities divided by total equity. He has a debt to equity ratio of 1.45. Is that good or bad? Remember, he's wanting a loan for this new contract. Don says good. Yeah, because we want it to be 2.5 or less. That means he's actually pretty good at managing debt. He can take on some more debt, right, and not be in trouble. So this is actually pretty good. Even though he has bad trends, even though he has an expense control problem, he actually has a good hold on the way he manages debt in the company. All right, that's number 3, debt to equity. The next one, everybody's favorite, EBITDA, right? I doubt if anybody ever calls their accountant and goes, hey, what's my EBITDA today? Unless the banker is trying to get you to pay attention to it. Because EBITDA is a substitute word, a proxy word for the word cash flow. It's a substitute for cash flow from the banker's point of view. It's like true cash that's actually coming through the business. And the reason why they calculate it is because it puts every company on the same level playing field. And you're like, oh, how does it make every company look the same? How does it put them on the same playing field? EBITDA takes out all the effects of any decisions that we make about how we finance our company or how we choose what accounting method that we use. Let me give you an example. We're going to add back in interest, right? Why do they add back in interest? Well, because some people use debt to finance their company and they pay interest as part of their debt payment. Some people use equity as part of their financing and they don't pay interest. If we add back in the interest, those two people look the same. It was money just used to finance the company. Taxes are added back in because they're not operational. They're just a result, right? I only pay taxes on whatever's left over. So we add those back in because they're not an operational expense. The next two, depreciation and amortization, there's 2 reasons why they get added back in. The first one is they're non-cash. Nobody ever writes a check for depreciation. Just they don't. The second reason is that you might choose a different depreciation method than me. You might use the straight line method and I might use the double declining balance method or the activity method, or it doesn't matter. There's like 10 of them. Because we don't know which one you're going to use, it doesn't matter. We're going to add it back in. So I look the same as you, no matter what you did with your depreciation method. And the only reason they choose the method a lot of times is tax. Now I say that, and then I'm going to throw in some bonus material here. Why do you think somebody uses the double declining balance method? So this is depreciation, that's time, right? This is depreciation, that's time. Double declining balance, first of all, straight line is just, I take the same amount every single year. Double declining balance is I take more up front and less later. Why does somebody choose this method over this method? Anybody? Yeah, it's hard to, why do they do that? Some people go, oh, it's because they pay less tax. When they take more depreciation, they pay less tax because depreciation will reduce your net income, right? But then I say, well, what happens down here? Are they voting to pay more tax later? Because if I'm going to pay less tax here, it looks like I'm going to pay less or more tax there. Whereas on straight line, it's the same no matter what year we look at it. Well, here's the reality of it, is that there is another reason to use double declining balance, because there's another set of expenses on equipment that you can depreciate. They go like this, which means it smooths out. This is called repair and maintenance. And the thought process is that early on in the life of the equipment, I don't have any repair and maintenance expense. Later on, I do. So I'm going to flip-flop them. I'll take repair and maintenance later, and I'll take less depreciation because I know I got more depreciation, less repair and maintenance. And generally what you're doing is still trying to get to this. You're trying to get a more predictable expense stream for that piece of equipment over time. Does that make sense? Yeah, that's way out of bounds here, but I thought it was interesting. All right. So everybody know the difference between depreciation and amortization? Anybody? What do you depreciate? What do you amortize? You're going to depreciate things you can touch, right? Loan versus asset. You're going to depreciate things you can touch. You're going to amortize things you can't touch. like goodwill, like patents, like trademarks, like things like that. So things I can touch, physical assets, you depreciate. Non-physical, intangible type assets, you're going to amortize. It's the same calculation. The reason why they do it, depreciation, is you're spreading out the cost over the life of the asset. And you're like, oh, what's the life of the asset? Well, if the government has this class of assets, and we'll say that you can depreciate something for 5 years, what they're really telling you is that you are supposed to be earning money with that piece of equipment for at least 5 years. Remember, the only reason to buy a piece of equipment or an asset is to generate revenue and profit. So if they're saying that we think that the useful life means it generates revenue for 5 years. So because of that, there's an accounting principle of matching, where the expense that you incur to generate revenue should be recorded in the same period of the sale. So if I make sales in January, all the expense using my equipment should be recorded against that sale, right? That's the principle of matching. Well, I know that gets a little bit, and you're like going, great, Mike, I don't care about any of that because I'm just a business owner. I'm not an accountant. You got way over my head. Let me show you how you can use it. But I'm telling you why other people use it. Now I'm going to show you how a business owner can use it. So first of all, it's a substitute word for cash flow. But have you ever done this? Have you ever went in to get a loan or seen people go in to get a loan and the banker says, well, how much do you want? And you go, I don't know. How much do you give me? Because you don't know how much to ask for. Well, this is how you calculate up how much you can ask for, because this is the number that the bank uses to determine how much you can afford. Because remember, the payments that you make on loans for long-term debt come out of your profit. EBITDA is your profit, right? The cash from it. So across the country, the safe bet is 3 times EBITDA. That's about how much you can afford. So if I'm making $100,000 in EBITDA, that means the bank's going to give me about $300,000 at the max level. If I ask for $600,000, they're going to go, no, we're not going to give you 600, but we'll give you 300. Why? Because that's what you can afford. Most business owners don't know that that's what they can afford. They'll go, oh, I know this game. I asked for 6. He said 3. I'll take 450. Look, they think they're in a negotiation, and you're not. They've already determined that that's about how much you can afford without getting into trouble. So 3 times EBITDA. And the other thing you can use this for is debt service coverage ratio. And you're like, oh, what's that? First of all, I'll tell you what the equation is, but it's more about the answer. Debt service coverage ratio is what banks use to determine how much money you have available to make a debt payment. The way they calculate it is EBITDA divided by the current portion of long-term debt plus interest. So how much are you going to make in total payments this year? That's what current portion of long-term debt plus interest means. I make a debt payment of $1,000 a month. That's $12,000, right? That's the principal and interest together. So, but what you need to know is when you see anybody talk about DSCR or debt service coverage ratio, you want that number to be at 1.25 or higher. So just circle that 1.25. I'm trying to give you answers to banking test, right? So the stuff that they won't tell you what they're looking at when they take your stuff behind the green curtain and do all their calculations. But what this is saying, that 1.25 or higher, is for every dollar in debt you owe, you got $1.25 or more to pay for it. That's what debt service coverage ratio means. For every dollar you owe, you got $1.25 or more to pay for it. So you want that number to be as high as possible, because that's what they're going to determine. Okay, so in Sammy's company, let's calculate up his borrowing power, so to speak. First of all, he has EBITDA of $385,000. If I multiply that by 385 by 3, he can take out at the max $1.1 million or 1.2. They might round up, right? So 1.2. So if that's true, you also have to ask the question, how much does he already have, right? Because you can't just say, oh, I'll get 1.2, go ask for that. You got to look and say, oh, I've already got some loans out there. Well, he already has $713,000 on the books. So he only gets the difference. Think about it like a credit card. He's got a balance of 700 on this credit card, but that means they're only going to give him about $442,000 more. They're not going to take him up over 1.2 million. So $442,000 more. So if he needs a piece of equipment for 500,000 or 550,000, they're going to say, I want you to come up with a down payment of 100 or 50,000. Not only do you have skin in the game, but it puts them in their debt to equity ratios and their debt service coverage ratio risk band that they're happy with. Does that make sense? It gets a little complicated, but just know this. EBITDA times 3 tells you about your max. So you don't go in and ask for something crazy and get declined and feel bad about it. And then this is about what you're probably going to get based on what you already have out, right? So that's kind of how you can use it on a regular basis. Okay. That's number 4. See, we're cranking down through them now. So number 5 is mismatch financing. You're like going, that's weird. I've never had a business owner look for mismatch financing. The reason why I'm showing you mismatch financing is that this is the silent killer of businesses. 60% of small businesses right now have mismatch financing, and nobody ever walks out on their front porch and says, I am going to mismatch finance my company today, right? It just happens, and you don't realize that it even happened until it's too late. And you're like going, what is this mismatch financing? Mismatch financing is using the wrong product to buy something, using the wrong type of loan to buy something. For instance, would you buy a house with a credit card? Come on, great miles. Paula, think of the miles you're going to get. You buy a house on a credit card. No, why wouldn't you do it? Credit cards are like 25, 30% interest, right? Mortgages are about 7%. When I said it's a silent killer of business, it's because people are just writing their payments every month and they're paying 28% interest when they could be paying 7%. It sucks money out of the company in the form of interest. Now that's a gross example, mortgage to credit card. Nobody's really doing that, but it happens this way. If you have a line of credit, that's the same thing as having a credit card. Or if you have a credit card and you put something you can depreciate on it, you've mismatch financed it. It happened to me. I had a cooler breakdown in my restaurant. I ran to the restaurant supply store, put my cooler on a credit card, thought I saved the day. Put like a $10,000 cooler on a credit card. Well, the credit card at the time was almost 14% interest. I could have had a term loan for that at 6%. So think about the difference there. I'm paying 14% interest on something I could have paid for 6%. And you're like going, well, how do I know which product to use when? Here's the rule. The length of the loan should match the life of the asset, right? That's pretty important. The length of the loan should match the life of the asset. If you can depreciate something for 5 years, then you buy it with a 5-year term loan if you don't use cash. If you're going to buy cash, it doesn't matter. If you're going to use a loan, a 5-year loan, that way when depreciation ends, so do your payments, and you're at a good spot to replace. So the length of the loan should match the life of the asset. If you can depreciate something for 5 years, buy it with a 5-year term loan. Does that make sense? All right. So here's how you find it on your balance sheet, if you've done this or not. First of all, we're looking for an increase in gross fixed assets. So when I look at his gross fixed assets, it might be listed on yours as property, plant, and equipment, or furniture, fixtures, and equipment. It just means fixed assets, right? Stuff you can depreciate. So it went from 2.2 to 3.4. Did it go up?
Mhm.
Yeah, that means he bought stuff, right? So remember, if I bought stuff and I financed it right, I use cash or long-term debt. That's the only 2 ways to do it. If I didn't use cash or long-term debt, then I probably use short-term debt called a current liability, and I'm probably paying too much money. And I can reduce the amount of money that goes out every month just by changing it. You're not taking on new debt. You're just moving it off your credit card into a term loan, right? Refinancing, so to speak. All right. So if we did it right, remember it should only be long-term debt or cash. Why am I calling retained earnings cash? Because that's the profit that goes on the equity, right? Profit is cash. It's in your bank account at the top of the balance sheet, in your cash or your AR that becomes cash, your accounts receivable. So long-term debt or retained earnings is synonymous for cash. So here I'm going to look at these should equal. This is a variation of the basic accounting formula. Assets equals liabilities plus equity. The only thing I've done, it's called a derivative, is I eliminated all the current assets and I eliminated all the current liabilities and some other equity stuff. But these two should equal if we're using cash and loan products right. So here we got it. Long-term debt went from 989 to 713. It went down. So that makes it harder to equal 1.2 million, doesn't it?
Mhm.
Retained earnings went up, but only went up $100,000. So does 200 or 1.2 million equal negative 152? No. Chances are that he bought something with the wrong loan product, right? This is if you're a business owner or if you're an advisor, you got to ask yourself two questions or one question, not two questions. What did I buy? How did I pay for it? Because here we bought something, but I didn't use long-term debt and I didn't use cash. But look what happens to his notes payable, his line of credit. Goes from 2 to 7. You see how his short-term credit came up? Chances are he bought something he depreciated on his line of credit. And it's easy to do because it looks like a checkbook. And you're just going, oh, I'll just put it on a line of credit. It's just money. It's the same thing. But it's not the way you're supposed to use a line of credit. You're supposed to, use it to fund your labor if you're in a service company, or to fund your assets if you're in an inventory-based company, right? Your inventory. Okay, so in this case, that's called mismatch financing, and chances are he's paying too much interest. So how should I finance things, right? How should I finance things? This is how you structure debt in a small business, the basic foundation of every business. And I'm going to blame my mom, right? I'm going to blame my mom for me not knowing this sooner. You're like, what? What does that mean? Well, the reason I didn't know it sooner was because she wanted me to be a doctor. Then she wanted me to be a dentist and all these other weird things that I just wasn't going to be. Because she started seeing my scores come in for high school biology and chemistry and all that. And she goes, yeah, you're just, what about a lawyer, Mike? You might be able to do that. But all of these things she wanted me to be were individuals that run their own business, but they don't build transferable value the same way. When a doctor retires, I don't necessarily just go with the new guy, right? I go shop doctors, same way with my attorneys and accountants. If she would have said, Mike, you should be a beer distributor, I would have got debt a lot sooner. Because think about the beer distributor. You don't care who that person is. You just buy the beer, right? It just shows up. Who cares who runs the place? But when you pull up into it, it has stuff. It's got forklifts and shelves and buildings and all these things. That's called gross fixed assets, what we just talked about. If you're going to buy these, the loan product you use is called a term loan, right? And you're going to match the life of the loan or the life of the asset with the length of the loan. The money that you use to make your loan payment comes from your net profit, right? That's what they're going to use to determine, can you afford this piece, is net profit. Now, the second part is where everybody makes a mistake. The second part is the hardest part to do. And if you haven't done it this way already, it's okay, because we can get you back to this point. But the second part is your base level or permanent working capital. And if you're an inventory-based business, if you do this right, you'll only ever have to buy inventory one time out of your pocket. Other than that, your customers will replace it, right? When they buy it, you take their money and replace it. So let's assume that I need 20 units of something. We'll say Budweiser. And if you've ever been to a convenience store, it always looks like it's nice, neatly faced, and everything's looking just great across, across the shelving units. How do they know how much? Well, they've calculated up a PAR level, which is periodic automatic reordering, PAR. And what they've determined is, on average, I sell about 20 cases of Budweiser a week. So most weeks, as long as I order back to 20, I don't run out. I don't have too much. I don't run out. I just know that 20 is about the number that we buy on most weeks. Well, The first time I buy that, I should buy it, if I don't pay cash, buy it with a term loan, a 5 to 7 year term loan. I think the SBA's got an inventory based loan for it. If you do that in 5 or 7 years, you own all the inventory. And we make term loan payments using net profit. But during the week, people are buying the Budweiser, right? They buy their Budweiser, and at the end of the week, the rep comes in and says, how many do you want to order for the next week? Well, when I order 10, we'll say, because people bought 10 and I ordered 10 more, get back to the 20. I don't want to go to 25 or 30. I only want 20 because that's all I need. The vendor's going to give me an invoice. Okay, here's your 10 cases of beer. Here's your invoice. I'm then going to take the customer's money, the ones that bought the 10 cases, and I'm going to use their money to first pay the vendor's invoice and then use the rest to run my business. Does that make sense? Take the customer's money for the beer that they just bought, take their money, pay the invoice, use the rest of it to run your business, right? You can't spend your cost of goods sold money. You have to be able to keep it and replenish your inventory. Now, here's what happens during the year, though. Sometimes I need more than 20 cases of beer. There's Super Bowl, there's 4th of July, there's Cinco de Mayo, there's all these holidays. And so then I have to bring in a little extra. And when I bring in a little extra, where does that money come from? Because I just told you that if you ever did this, you'd only have to use your money one time, which is the first ones in the term loan. Well, this is where it's called seasonal working capital. It only happens every once in a while. I need more beer, right? This is where you see grocery stores have the big structures and end caps of things that they just build with cases because it's 4th of July or whatever's coming up. Well, if that's the case, how do I pay for that extra 10 cases? That's when you use your line of credit to buy the 10 cases. Well, where does the money come from that? When the people buy the 10 cases, I take their money, pay the line of credit, and I'm keeping the balance down. With a line of credit, you need to pay it to zero one time a year. It's a lot easier to do if you're paying it back as soon as it's used, right? And you're supposed to let it there. Now, if you're in a position where your line of credit has a balance right now, you're like, I'm never going to get that down to zero. A lot of banks will give you a get out of jail free card. They will take the balance of your line of credit and convert it to a term loan. Right? They'll take the line of credit, convert it to a term loan. They say, we're going to term your line. We're going to convert it to a term loan, not terminate it, not end it, not yank it, not pull it. They're going to term your line, convert it to a term loan. If they do that, guess what you just did? You automatically set this up in the right order. So if you have a balance on your line of credit and you don't have this term loan for Krista, for payroll, I had my line of credit was for payroll. As soon as the customer paid me, then I would pay whatever I borrowed to make payroll. I would pay that and use the rest of the money to keep running the business. So when I say inventory, you need to think payroll. Make sense? Okay. Now, at the beginning, I promised you I could teach you how to read a cash flow statement in 15 seconds or less. I guess I did come up with 2 hours of stuff, Paula. Sorry about that. I can just keep going. You sat in a 6-hour one.
Yep.
So, all right. Now, remember in the beginning, I told you there's 3 different sections, right? There's operating activities, investing activities, and finance activities. When you look at a cash flow statement at the bottom, there's usually a summary, and you'll see these 3 numbers. In order to read a cash flow statement, all you need to do is be able to determine, is it a positive number or a negative number, right? Because then we're going to create what I call the cash flow activity pattern. So this 25, is that a positive number or a negative number?
Positive.
Positive, right? So we just put a plus. So down at the bottom of your cash flow statement, just put a plus. Down here, 21, positive or negative?
Negative.
Negative, right? And then 3 is also negative. That's plus, minus, minus. If you keep them in this order, operating first, investing second, financing third, there are only 8 possible combinations. Plus, 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 minus, 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 plus, minus, minus, minus. Only 8 ways that these fit together. Because there's only 8 ways, I made a chart. I go here, I go plus, minus, minus. And remember, the cash flow statement is a tattletale. It says, hey, I'm using money from my operation to buy assets and pay down debt or pay the owners. Remember on Sammy's company, Assets were going up. He was paying down debt. Remember that? Tells on you. No matter what the story is, this tells you what's happening inside the company. So the worst one, by the way, is minus plus plus. It's called the death spiral, because this is saying that I have a cash flow shortage. My business doesn't cover its own bills. And then I'm selling my assets or asking the owners for more money to keep going. That's what makes it worse. I'm selling the assets. You know, if you sell assets, you're reducing your amount of your ability to make more money, right? Because the only reason to buy an asset is to make more revenue and profit. If I'm begging the owner for more money, they're not going to like that. I wouldn't like it. So the other ones are bad as well. Anytime you see a negative in operating activities, consider that in a bad direction, right? So let me show you just the app real quick and just show you how this kind of plays out, and we'll end up today. So share. I want to share Chrome. And so I've got an app. All the stuff I'm going to teach you over the next couple of weeks here is in this app. It's called the Clear Path to Cash. And I'm in the demo company, but today we went over the home run financial system, right? So when you have your periods in there, I need to refresh that real quick. It's been sitting open too long, all week. Can't tell if it was refreshed. Yeah, I guess it did. There it is. Period 1 to period 5. So this is Sammy's stuff that I put in here for you. And basically what we're doing is we're saying, listen, these are the numbers that are coming down. We use the KISS method. You're going to get closer to actual with him. His net profit was down 100,000 in our KISS method. It's down 122 here. But each time I'm going to show you a graph. And if you want to look at things more succinctly, you just turn this off. I want to look at just what gross profits is doing. So I can turn things off by looking at the legend. And there it is. Gross profit's not looking good. If it feels like you don't have a lot of money to spend, well, look here. You used to have a lot more. No wonder. But then I'm also going to do the analysis for you, right? I'm going to show you what's happening. So I'm going to take that trends cheat sheet and tell you about it. In expense control, it's going to tell you how much to cut. This company needs to cut $122,000. So it's doing the math for you and tells you what to do next. Then, of course, we got debt to equity ratio, something we also went over. 1.45, and I'm going to say, hey, this is great, because remember that number needs to be 2.5 or less. So say you're doing great managing debt. Then goes, of course, EBITDA. A couple of different things here, right? I'm going to do the borrowing power. If you are going to ask for a loan, it probably needs to be at 907,000 or less, right? So I'm doing those calculations for you. You might be able to borrow up to about $900,000, right? So that's basically what I'm doing, is kind of putting you in the ballpark so you don't look silly when you go ask for too much at the bank. And mismatch financing, I do that calculation for you. Yep, go do this. And then I'll say, what did you buy? How did you pay for it? Contact the banker, right? So those are the things, all the stuff we just taught is built into this product. And cash flow activity pattern, minus, minus, minus. Here's what's happening. Companies using cash reserves. So those are the things I'll be going over in the next couple of weeks. We got the fast money formula, hidden cash. We'll be going over those in the next couple of weeks. So I cannot believe I did 2 hours. I thought I had about an hour and a half, so I must have really got on a roll. Gave you extra bonus material. Questions, comments, concerns, moans, groans, gripes, complaints, otherwise?
Just an observation, Mike. I forgot there was this much math involved. So
Too much?
making me think.
It gets easier. The next two get easier.
Great. Any questions? Anybody have any additional questions? If my brain wasn't like fried by now, I would probably have some questions. I'll write them down and let you know next week.
Okay, fair enough.
Mike, this was great. This was great. And I remember a lot of the class that I took last year at conference with you. It was amazing. And I also remember how what a short attention span I have when it comes to mathematics. We're good.
Yeah, I definitely appreciate you.
Yeah, we're enjoying it. It's going to be great. We have a couple left with you, and it's going to be great. Just want to mention here's a list of some of our upcoming webinars. You see two on the 20th with Stacy Kildall. One of those had to be rescheduled from this week, so we've got back-to-back Stacy that day. And just go to our website. You can use the QR code at the upper right-hand corner to access our website. That's where you can register for the webinars. You can get our contact information or schedule an appointment with an advisor. There's also some resources on the website that you can use before talking with us, or during our conversations when we meet with you guys. Want to thank our benefactors. We are grant funded, and that's why we can provide these services to you at no cost. So we are supported by the Small Business Administration and the state of Texas, North Central Texas SBDC Regional Office in Dallas, and our host institution, North Central Texas College. Thank you all for joining us today, and we look forward to seeing you next time. That would be tomorrow for Bryce Forney and how to find and how to approach and identify the right tax preparer. So y'all have a great day. We'll talk to you next time.
All righty. See ya.
Thanks.